These footprints expose the cartel's weak hands. And as we will see, some of these price dislocations are mind-blowing and are drawing unwanted attention.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and I'll be your host for this week's episode, and I'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets, and we expose what's really going on in the precious metals industry. Get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media will not provide. So just before we head over to the UK, please help us spread the word about this channel by hitting that like button right now. Share this information. If you haven't already subscribe to the channel and click on the bell notification. We'll notify you as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Now, Andrew, it looks like the strong coiling of the physically driven rally that you anticipated in our last market update only 2 weeks ago finally broke out of its suppressed range. Can you tell us what you're seeing right now and what to expect moving forward?
Great to see you, Shane, and great to be with everybody. Yeah, look, this is a great place to start, Shane, and really to give us a better view into the footprints in the multi-trillion-dollar gold market. Let's start by looking at these same actors' easier-to-read footprints in silver, as the smaller silver market actually provides us a clearer window into what is the deliberately opaque world of central bank managed gold markets. Now, also what I want to do at the same time is really to answer a myriad of questions from really understandably delusioned silver investors on how is it possible when we now witness gold reaching today again and closing yesterday at all-time highs, why silver is not by now also trading at its 2011 all-time $50 highs. I mean, this is a question, and to be honest, I must get 10 calls a day from really savvy people saying, what's going on? And using more colorful language than that. Now let's step back and look at the silver cartel structure. And while we're looking at these same actors, it's really how the foreign exchange silver markets differ from the Basel III compliant delivery gold markets. But hence, there's a difference. But as we will see, the natural forces are about to catch silver up to gold in a very, very dramatic way.
Wow. Well, Andrew, I revisited our Live from the Vault episode way back in December. Catch this one, 2022, where you lifted the lid on how the silver cartel operates. You went through all that. This was incredibly enlightening. Can you sum up what you uncovered back then? Just bring us back to what you were talking about and how it revealed all the vulnerabilities here.
Yeah, good idea, Shane. And our longtime subscribers will actually recall it was back in the end of the year, December 2022. I think it was the last episode of December 2022, where we poked a big hole in the 28th of November LBMA silver presentation, which provided a very rare glimpse into the smoke and mirrors world of the LBMA. And this was prompted by them scrambling to address the obvious silver market price disparity versus what was then a very tight for supply, high premium physical market commanding record large premiums over the COMEX generated price. And that really caused a lot of questions, and it forced them to address it. And this is the first time they ever exposed that essentially exposed they were a cartel. So back then, this far too obvious disconnect between the tight supply, wholesale physical markets and the physically unattainable paper-generated low prices had by November 2022 become an embarrassment. But what prompted this very revealing presentation was an attempt to play defense. So with the cash-settled COMEX futures markets, really what happens then is they began to be put into the crosshairs for physical delivery in the COMEX. So in a desperate attempt to gaslight the industry, this presentation, which was titled Silver, the Ever Capricious Metal, was an attempt to spin the idea that it is perfectly acceptable to have a professionally managed 100-to-1 paper settled market, and this is all for the derivative reasons. Oh yes, we provide services to the miners. We need this leverage, meaning it's actually okay for the leveraged paper silver markets to set the price for each single ounce of physically held silver, fractionally underpinning 100 ounces of paper silver. Ludicrous. Now, this video present, I can understand 5 times, 3 or 4 times, in order to flywheel certain producer financing, etc., etc. 100-to-1. This video presentation was the first admission of the silver cartel's existence, whose footprints we've been exposing for decades. Amazingly, this video is still available on the LBMA's website. I don't know how much longer for. And as you recall, Shane, we looked in granular detail at this embarrassing presentation in our December 2022 Live from the Vault episode. But in summary, the presentation title pretty much said it all. They called it, what does capricious mean? It means inconsistent, fickle. But history actually shows that there is nothing inconsistent about the LBMA cartel fixed price. It is consistently and without exception, it fixes the global silver prices well below the actual deliverable wholesale physical silver price. That is what is confusing even the largest wholesale brokers that we deal with. And this makes an absolute farce of the daily global silver fix that is supposed to benchmark a deliverable silver price globally. And what the fix consistently benchmarks is actually a paper settlement price that is netted out just on the books of this daisy chain of highly leveraged LBMA members, these member banks, which we call the cartel, with actually very little physical, ever-changing hands. Instead, these same actors collude to actually then flywheel sufficient paper market volume into the siloed US futures markets to technically chart paint, really, their cartel-defined synthetic ranges that can be profitably gamed by their high-frequency trading algos, which is leading the specs by the nose to automate buy and sell orders at these synthetic pivots that they create. And this so-called professional trade uses these useful tools to ensure that this bifurcation of the silver market price so as to provide the illusion of a real physical price, whereas it is in fact determined by a bilaterally settled price off the grid, which you don't see because it's one-on-one settlements. Now, the cartel's so-called professional traders referred to in this LBMA presentation are orchestrated by the 4 key market-making volume banks listed on the quarterly Office of the Comptroller Precious Metal Report. You only have to have a look. Identified JP Morgan, Goldman, Bank of America, Citi. All of them have big skin in the game. Now, having skin in the game is where the problem actually lays. A true market maker does not have a directional agenda. But as we've recently outlined, the backdoor loadouts coming to the back door of the COMEX vaults also exposes their Achilles heel to an increasingly depolarized global market who has turned on the COMEX to directly load out physical silver at a few cents over the gamed paper price. This is a huge vulnerability. And as market makers, these 4 traders have maintained such a tight grip on the wholesale market, providing specialized metal banking services for the LBMA accredited producers and the refiners, which then cleverly, through anti-money laundering and KYC disclosures, it exposes non-LBMA buyers' names, these people are attempting to circumvent the cartel, going direct to the refiners and trying to grab that supply before it gets into the LBMA. And so, so basically, the cartel is withholding supply. And as we've detailed in the past, really to bully the producers into rationing physical supply to non-LBMA members. Now, we reported being red flagged. This must be 3 or 4 years ago. It was UBS at that time warning the second-tier Swiss bank that was acting as our intermediary at the time that they would be blacklisted if they pressed our refiner for delivery. Now, a large physical order seeking to jump the LBMA ring fence is actually just automatically red flagged through this process. They can visually see, when you use banking services, so you can see what's happening. A big order is red flagged. And essentially what they do is imposing a moratorium on large orders being able to leave the ring fence they depend upon to run the paper containment game. And this is why we've recently been drawing attention to how the cartel's greed has backfired, evidencing silver being leaned on for physical delivery in the usually cash-settled COMEX futures markets. Now, I bring this up now as we come full circle to what we drew attention to in that episode, actually in our last episode, which was the refusal of the LBMA self-named so-called professional trade to make good on over 2,000 tons. If you remember, there was orders of over 2,000 tons of Indian and Chinese salt refinery orders from European refiners, from Valcambi, from all the big names, because they wanted it at the spot silver price. Now, if you recall, throughout February, we, along with every other desk, were receiving frantic calls from European refineries trying to fill these spot indexed wholesale orders. So you buy the spot contract, you go into the refiner and say, here's my spot contract, fill it. And there'd be a little premium over that. But their refusal to deliver into a global market sent a message to these multipolar buyers that silver's grossly undervalued. And what has happened is that the so-called LBMA silver, I keep calling what their name is, London Professional Trade, just call them the cartel. What they've done is run headlong into an unprecedented physical tightness that has now driven a structural supply-demand imbalance not witnessed since the March 2020 COVID refinery shutdowns drove a $17.91 rally from $12.05 to $29.915. So only this time the rally commences at a $10 higher level. Now, a structure that is far worse than anything the cartel has ever run into. Now, given the disconnect between the COMEX-driven price and the deliberate withholding of supply, this is a really big deal. And following years of having the COMEX ring-fenced, the LBMA has to deal with some very unwelcome, globally motivated guests exercising their right to load out physical silver at the COMEX casino's back door. And there's very little the cartel can do about it. You buy a futures contract, you're authorized to buy a futures contract in size. Now, you can do it. I don't recommend doing it but essentially you can do it because it's a synthetic market. And at some point, we could get a cash settlement on it. So really what I'm saying is above a certain size, we'll go through that. Above a certain size, you have to get a licensing to do it. And as we drew attention to in our last episode, unseen by the momentum-driven CTA herd who have actually been the problem, the London cartel's refusal to supply well in excess of over 2,000 tons of wholesale silver bar orders to refiners at spot prices resulted in the lack of refinery output being misread by this blinkered hedge fund group as silver market weakness. You have to give your head a shake. Also, this herd of CTAs were being gaslighted into misinterpreted the concurrent outflows of COMEX and SLV. SLV is the silver ETF. We've done episodes about this where you literally the illusionary ETF. But it can be tapped. If you're big enough, you go to your authorized participant and you can actually demand delivery of positions that you've bought. And so what they saw was the COMEX open interest going down. They saw SLV, the ETF. And we saw another 70 tons today with constant tonnage leaving. What they did was thought that was a validation of weakness, when in fact, these outflows were driven by liquidity providers representing Indian and Chinese buyers primarily, blocked by the cartel from obtaining sufficient wholesale supply at spot prices in the foreign exchange silver markets to lean into taking delivery of as much COMEX and ETF silver as they could get their hands on. However, the CME imposed COMEX position limits on how much of this synthetically priced open interest can be owned by a single entity to stand for delivery, which would mean they could then remove these buyers from the cartel's back door. Now, had it not been for the CME cartel-imposed futures markets position limits of 3,000 lots per single entity, that's 467 tons per qualifying institutional client, then just last month alone, just in February, the COMEX would have been drained of every single ounce of fractionally held registered bars. And this is where the once justified 100-to-1 leverage, the LBMA really blows up in the cartel's face by starving the booming global South buyers of supply. Their liquidity providers have naturally turned their focus onto the only deliverable source of bullion at spot prices. Yeah, they don't want to go into the COMEX, but they know that if they go in, they can, and they fully fund that contract, they can take delivery. The COMEX. And also, they've also been tapping the SLV ETF, the silver ETFs. In the process, what they're doing is exposing thousands of tons of unbacked paper silver warrants professing to back up what is a 93% leveraged registered inventory. And what they're doing is just moving and completely unleveraging that 93%, fully funding it and loading it out from the COMEX vaults. That is large enough to expose the house insiders to an ultimate COMEX market default. And the current action tells us we are very, very close.
Now, Andrew, I can guess what our community is probably thinking about now as we're following along here. Run through how close are we to this?
Yeah, we need to look at this. At current silver prices, at around plus or minus $24, all you need is $8,000 or just 6.7% to control each silver futures contract valued at $120,000. And given that 75% of the COMEX generated open interest is corralled in the hands of really a stampeding, led by the nose CTA herd who max out these position limits, but they never take delivery. Obviously, by never taking delivery, but because physical buyers have entered the fray, up until physical buyers entered the fray, it was easy to control the price, with the insiders loaning literally billions of dollars of unbacked paper open interest. We call them casino chips, to the herd. And insiders have been able to historically create what we just talked about, a defined wash and rinse cycle that both enrich them, but to also control sufficient open interest chips to create a synthetic silver price far below the 16-to-1 gold to silver ratio. Now, however, this is a classic case of pigs get fat, but hogs get slaughtered. the current refusal by the London professional trade, the cartel, to provide thousands of tons of silver to meet refinery orders has placed the crosshairs on this 93% leverage COMEX Achilles heel. And leverage can work for you or against you. And while the cartel has historically been able to game this in their favor, greed has attracted a large enough, diverse group of wholesalers to secure their maximum 3,000 lots of COMEX synthetic silver and then to stand for delivery. And unlike any time since March 2020, this physical demand is sufficient to tip the balance against the cartel. And we don't even have a COVID panic this time. Liquidity providers confirm that a much larger, diverse group of traders are appearing, each one of them taking their limit of contracts, and they're appearing with the sole intention of taking delivery of extremely cheap COMEX silver. And while limited to just 3,000 lots each, these groups are swelling in size. And while dwarfed by the momentum CTAs driving over 75% of all the action, which is why you don't see it, it will be the forcing of delivery of these targeted contracts that of which is forcing this 93% unwind of synthetic open interest that is going to tip the balance. And this is just as we reported the effect of central banks forcing 96%. Remember, we talked about this last time. The central banks are forcing 96% deleveraging of COMEX, NSFR compliant, deliverable gold, and that, which has been attracting the central banks and sovereigns to do the same, and ultimately forcing the current breakout from the capped ranges. Now, the difference is that while COMEX is first-tier Basel III compliant, i.e., forced to be deliverable the moment it lands in the over-the-counter markets, so really they target, to get this out, you target the EFP, the Exchange for Physical Backdoor, which forces delivery of non-compliant gold into the Basel III markets. But silver doesn't do that, because basically, if silver targeted the same EFP backdoor, because it's not NSFR compliant, it would simply feed this unallocated silver back into the hands of the cartel, enabling this eternal circle that we've been seeing. So as far as non-compliant silver is concerned, it is the concatenation of the two misread signals that we talked about, which has evidenced these blinkered CTAs doubling down on their naked, I will say, naked gross and net short positions into every physically driven rally. Now they're getting caught out. But this is what's driven, it's their action that has driven, you notice we talked about from every pit open to every pit close, we've seen automated selling, mindless chasing a dot on screen, oblivious to everything else that we're talking about. And we saw that in every session during the last 4 weeks, and you wonder why silver was underperforming. And so really what we did evidence at this point, though, was actually 458 tons of COMEX deliveries alongside about 130 tons of SLV ETFs during February. And now this has picked up significantly. So really, they were looking at that as weakness, when in fact, they were just misreading what was actually very, very bullish. And that was just February. Now, this is significantly risen. And we're going to show you some mind-blowing stuff in a minute. Now, but given the CTAs are the recipients of about 75% of all the COMEX gold and silver open interest, if you remember, that was attested to by Bloomberg, noting this same group of specs control a similar concentration of gold as in the oil markets. And so basically, we have a Goldman assessment we're going to link, which was captured by Zero Hedge. It's easy to read. It lifts the lid on these same synthetic CTA actors controlling what is a similar 75 to 80% of the oil markets. And the article was titled, "Oil Spreads Soar as Physical Market Tightness Press the Hedge Fund Shorts." Now, it's pressed by the hedge fund shorts. So I'm just here. Here, I'm linking it here so you can just see where that link is. Now, the only difference between the same actors' activities in the gold and related silver markets is that while officials deliberately lead these CTAs by the nose to take the short load in oil, and this is to politically suppress the crude price ahead of the upcoming election. Yeah, they do anything to manipulate the markets. It doesn't matter what they're actually the longer of term effects of this, but that is why they're allowing this huge concentration. Now, these same officials are also officially intervening in bellwether foreign exchange gold and silver because they expose the extent of Fed-driven dollar debasement.
Now, Andrew, as you say, attracting more physical silver buyers to take physical delivery of the COMEX silver presents an unprecedented, I think, bullish setup for silver. Do similar COMEX positions, those limits in gold, favor the cartel or the central banks?
Yeah, really good question. And while the billions of dollars of freshly conjured up COMEX gold warrants that get battered around inside this siloed COMEX casino, while they're not Basel III compliant or physically backed, these synthetically priced undeliverable COMEX gold warrants are able to be trained out through the COMEX EFP backdoor. We talked about this before. And unlike silver, the moment these gold warrants land into the NSFR compliant LBMA over-the-counter FX gold markets, these COMEX price paper gold outflows become physically deliverable at the discounted underpriced spot gold price. And as we've been drawing attention to, competing central bank sovereigns and institutional buyers are aggressively attacking this gold discount window. This is what we're witnessing now. And to try and manage the balance between how much gold open interest officials can lay off on these led-by-the-nose herd of aggregated CTAs inside the COMEX casino versus the predatory exchange for physical buyers, the CME run COMEX imposes an 18.5-ton COMEX position limit on any single entity. However, due to the unwind of the 96% leverage to comply with NSFR spot gold requirements, this is equivalent to double that, to close to double that, 36 tons of paper warrants being squared. But even worse for the cartel, the outflow of synthetic COMEX open interest being alchemized into bullion in central bank size into already dwindling open interest. We talked about how that open interest collapsed from 800,000 contracts down to 4. I mean, ludicrous. It's ludicrous to see how 50% of all the open interest since 2020 has now evaporated. And it's limiting the cartel's bandwidth to effectively suppress the further out gold price of gold. Now, there are some limitations, though. And while central bank-driven market forces are now overcoming them, as we uncovered in our whistleblower dealings with the CFTC and was attested to by former CFTC Commissioner Bart Chilton, and I have actually created a link here for what he said, what he actually verbalized this. Not only did he talk about myself reopening the silver investigation, but he talked about how officials have regularly officially sanctioned their agent banks to exceed and then control massive position limit excesses on the short side to assist officials in managing and controlling the price in the directly related 10 times larger foreign exchange gold and silver markets. So remember, gold and silver are foreign exchange crosses against the dollar and etc., pound, euro. And while central banks openly admit to intervening in the foreign exchange crosses, they refuse to answer questions related to foreign exchange gold and silver interventions. And although we've seen that recently with Mooney, we've seen that repeatedly, Gata doing some great work, shaking this out, Powell refusing to answer those questions. Although gold is still somewhat impacted by these officially sanctioned position limit violations, this changed after gold was reclassified as a first-tier deliverable asset class on the 1st of January 2023. Now, gold is now ultimately deliverable, which limits the scale of interventions for precisely the exchange for physical loadout reasons we've just really outlined. However, as silver is not LFTV compliant, what we have been witnessing during 2024 trading began since the commencement of 2024 trading. Silver is being leaned on, psyoped to weigh on gold sentiment. This is how desperate they are. Now, the Fed intervenes in the foreign exchange gold and silver markets primarily because if they allowed an unencumbered real supply-demand price to be discovered versus the dollar in an open marketplace, it would expose the real inflationary inputs, which in turn would drive a further exit out of dollars to be exchanged for gold and silver. This is the battle that they're fighting, losing battle they're fighting. However, it's precisely those synthetic interventions that are driving the current physical market tightness. No matter what the commodity, there will always be a buyer and a seller. And the equilibrium price is what naturally emerges. So you take out the 96% leveraged synthetic gold supply, and most liquidity providers estimate that the current equilibrium price of gold would be around that same percentage higher, $4,000 per ounce on a bad day. And in silver, at $4,000 gold, a real 16-to-1 ratio would put silver at $250 an ounce.
Wow. Hey, Andrew, just before we started recording, you had mentioned an interesting Goldman Sachs structural analysis on how energy market manipulation lifts the lid on the paper gold. Can you share with us what we were talking about here?
Yeah, as Goldman put it in their published analysis of all crude prompt, which prompt just means settlement time spreads, and it was quoted, it's just how dramatically and rapidly the market has tightened up as a result of sudden scarcity of physical, however, has barely received any mention in daily discussions about the energy market. So despite this continued decline in supply and inventories of oil prices remain range bound and seem unable to break solidly above the low 80s. Why is that? In a word, financialization, aka paper oil. Because while the physical oil market is screaming higher, financial players, managed money, which is the CTAs that we talk about, continue to aggressively sell and short the sector. This in turn has translated into some of the marquee energy names, such as Exxon, seeing the highest short interest on record. This desperate attempt for financial players to keep their underwater positions from getting stopped out and sparking a cascade of margin calls has also translated into a ravenous shorting of energy stocks. Well, I mean, this is exactly, you could replace oil with silver, you could replace oil with gold. Actually, less so with gold now that it's become Basel III compliant. But really, we can replace that right now with silver. And don't forget, there's 75%. This is the CTAs are the recipient of around 75% of all the COMEX gold and silver open interest, which is, as we said, attested to by Bloomberg, noting this same group of specs have similar concentrations in the oil markets. Now let's look at the parallel CTA footprints in gold and silver in each of these components. So circling back to your opening question, Shane, looking at the current structure as we commenced March trading just last Friday, this is what we are observing. And I want to really give you what we're actually, from a wholesale market, from a perspective, what we're seeing. The main takeaways from the end of the month February action centered around a scramble to fulfill delivery shortfalls as the February gold futures contract moved into the last day to deliver, as well as the scramble to fulfill the March next contract up silver contracts as that moved into its first day of delivery. So one moved into its last day of deliveries, silver moved into its first day of deliveries. Both of these footprints expose the cartel's weak hands. And as we will see, some of these price dislocations are mind-blowing and are drawing unwanted attention. So in silver, as we've just outlined, the so-called, we're going to call them professional silver trading, the cartel, has once again demonstrated their ability to refuse to supply silver bullion, backing their FX silver trades at the current capped spot price. However, this is not the case in the related Basel III NSFR-compliant physically delivered gold foreign exchange positions, which requires these same LBMA actors, the gold cartel, to back every spot foreign exchange gold position with physical bullion, forcing what we call T+2 physical delivery. We talked about that before. It just means that once you've locked in the spot contract, because it's complied, must be delivered within 2 days. That is the inevitable coiling, physically driven Basel III compliant gold rally that will force the reversal of the naked short, non-compliant silver trade, ultimately tipping the balance for the CTAs to reverse their massively divergent accrued silver short positions. And this commenced on last Thursday's first delivery day for the March contract for some very, very, very good reasons. So large was the physical delivery demand in gold futures for the first time since March 2020, the COVID refiner lockdowns, since the 2020 refiner lockdowns, we evidenced the unprecedented scramble by insiders to short cover and deliver against really the undelivered, the yet undelivered, actually in default, February House held short gold positions, which given the large spreads to cover these shorts, revealed that the House had breached protocol by over-leveraging these so-called gold futures hedges related to these NSFR-compliant long spot gold over-the-counter positions in London. They had breached the protocol. It became clear as the last day to have closed or rolled or delivered the February gold contracts was on the 29th of February. And while it's not uncommon to see futures positions in temporary default, the House usually manages to create a subsequent synthetic waterfall event on the next trading session or two to cover excess lots against the speculators. And due to deliberately delayed reporting requirements, no one is usually the wiser. Wow. Given the new COMEX April contract immediately came under a predatory 71-ton EFP-driven attack as we record this on Wednesday, with yesterday's published data capturing just in the first 3 sessions of March, given the 96% paper leverage unwind to comply with his EFP lots landing on the compliant deliverable over-the-counter markets for physical delivery, this has so far forced 140 tons of paper to physical squaring event. This is not small stuff. It's 140 tons doesn't sound a lot. It is. It doesn't sound a lot when it's paper. It's a hell of a lot when it's physical. And this, in addition to also, we have the US jurisdictional guys also taking out gold on a lesser scale for US out of New York vaults for local delivery. Everyone else. Why would anyone else pay for air freight shipping when you can demand physical delivery loco London? Because that's what the EFP facility provides you. Now, the central bank sovereign institutional backdoor COMEX attack caught the House wrong-footed with insufficient CTA open interest to lay off these leveraged obligations. And the related undelivered February gold lots were exposed as in default, and this was evidenced with spot gold closing at a massive $47.30 premium to February gold, captured right here. At the end of the session, it meant that the insiders planning to shuffle February gold amongst themselves got caught out as these fully funded COMEX gold positions cost these shorts $4,730 per contract to buy them back. I mean, to buy back the synthetic side of these contracts so as to align with spot to bring them back into NSFR compliance. Now, by yesterday's PM fix, and we're just heading, well, in fact, we just had another PM fix just now, the cost to cover excess February short hedges had evidenced actually that the cost had gone bid only, reaching $96 per ounce and captured just here, as you can see in this link here, at $90.90. Now, The spot premium over the defaulted in-delivery February contract also drove commercials to fall over each other to also short cover front month April contracts, which are now the valid contract, which come into expiry at the end of end of March. They're now being aggressively what we call EFP, driving insiders to reluctantly do the same.
Now, Andrew, you also mentioned some unwanted guests in silver. Can you elaborate who these guests are?
Yeah, silver was also evidencing a similar short squeeze. And following a similar scramble to short cover silver into last Wednesday's first notice call, the open interest imbalance forced really a plus or minus 21 cents premium over the in-delivery March contract, and which matched a 21 cent discount in the May contract. Well, obviously, the May contract is further out, so you have to expect a premium because you have to have insurance, you have to have carry costs, et cetera, et cetera. So you would expect that premium to be around 21 cents for a May delivery contract. But the in-delivery contract was actually matching that and completely offsetting it. This is an evidence of backwardation. Illustrating what a huge shortage of physical supply. This is unprecedented and exposes the commercials scrambling to arbitrage the spread. And it also foreshadowed an upcoming much larger short squeeze. Then on Friday, to add pain to misery for the cartel, as silver came under delivery demands late UK session on Friday, illustrating just how wrong-footed these commercial CTA synthetic short positions had become into the supply shortage, into the physical shortfall as spot broke through $23 through the 23 round number. The premium over spot to short cover deeply underwater March positions that were in delivery reached a massive 53 cents per lot. That is 2,650 penalty to exit these naked short contracts. And obviously, as you can see, captured here. Now, the imbalanced scramble to square off short bets was a direct blowback that the LBOE London Trade's deliberate refusal to deliver on 2,000 tons of refinery orders, and which basically benchmarked at the daily T+2 FX fixes, with the bulk of these orders spot indexed below $23. This has created massive shortages in silver at current spot prices and has turned the liquidity providers representing Indian and Chinese buyers to focus on these outstanding COMEX SLV lots to force delivery. It's only just started to feed through to the deeply underwater CTA gross and net short, naked short position. Now, they sell the rally footprints into last week's deeply underwater options derivative bets, caught this herd of traders oblivious to this setup, which likely gets resolved quickly after non-farm payrolls on Friday, we're recording this on Wednesday, so you'll know what that is on Friday. Silver's ultimately coiled for a very large retracement move, indicating this would commence into delivery demands, but be further capitalized on next week. It will be the inevitable coiling of physically driven gold rally that will force a full reversal of the naked short silver trade, ultimately tipping the balance for commercials, for CTAs to begin to reverse some more layers of their massively accrued naked short positions in silver. I was kind of running out of time here. I was going to go through the COT reports, but I think one of the most interesting things about the COT report we saw in silver, huge disparity in gold, literally that $4,730 per contract premium to buy back these synthetic contracts on Friday will have everyone's attention, and it will put the COMEX in the crosshairs for more central bank EFP delivery attacks.
Now, Andrew, you have a link here for the INVESCO July 2023 Foreign Investors Report. I see that it verifies what you were assessing last year.
Yeah, it's nice to see independent assessments that back our previous assessments up. INVESCO's July 2023 11th, their 11th annual study, which is July 2023, study of foreign investors report verified that 96% of all global central banks have sought physical gold in record amounts, primarily as a safe haven asset class, swapping dollars for gold while gold ETF holdings fell, which is also what we've been talking about. These ETF reductions are actually something bullish, because what it involves is the authorized positions being forced, participants being forced by buyers to buy these contracts, these ETFs, and then demand physical delivery. Not something that a smaller trader couldn't do, but when you're a large size central bank, you can do this. Now, I've provided the link here for that, there will be a link for that report, just so that you have the detail.
Also, Andrew, one of the biggest questions we're getting again from the community is all of a sudden this they're looking for an update on the gold-backed BRICS currency. Can you tell us about that?
Yeah, it was interesting. Pepe Escobar caught up with Sergey Glaziev. He had a most recent interview discussing we talked about these two de-dollarization solutions. And as reaffirmed by Glaziev, one basket comprises of national currencies of all countries involved in the process, like the SDA, but with more clear, understandable criteria. Now, the second basket, and I think I'll just read what he says here. So basically, he says there's a huge expectation for the green light from the Russian government for a new trade settlement model, which is in the final stage of fine tuning. And he talks about the two baskets. He talks about the commodity basket that's backed with gold. And he's really just, I think, really what he's talking about here, and I haven't got time to go through the whole thing, but essentially the big takeaway from here is that really what's he saying in the first comment is that it is in the final stages of green light, and it's being fine-tuned. So watch out above. This is coming. So basically, I think this all leads really just to one question, guys, and it is the only question left. Given the physically settled global markets are now turning on to the undervalued COMEX futures exchange for physical delivery, and a real gold and silver price will emerge from the paper market ashes, how much physical gold and silver do you own?
All right. Thank you, Andrew Maguire, for talking gold. I guess talking a lot of silver today. And remember, to our entire Live from the Vault community, buy physical. Make sure it's backed 1-to-1, and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same, so don't be fooled. And there you have it. That's all we have for you today on another amazing episode of Live from the Vault. And please help keep spreading the word about this channel by hitting that like button if you haven't already done so. Share this information and also subscribe. And if you click on that bell right there, we'll notify you as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.